Well, I'm here today with my good friend Kevan Gorrie. This has become old hat for us. We've done a number of these over the years, and I always look forward to them because I not only hear more about what's going on at Granite, but I can hear a lot about what's going on in the real estate sector generally and the industrial market in particular. And we manage about $500 million in real estate assets at Middlefield, and Granite is a prototypical core holding for us. It offers stability, growth, as well as a growing dividend. And Kevan's done an excellent job at Granite since he joined over 5 years ago, really diversifying Granite within that whole logistics industrial market. And when Granite was spun out from Magna over 10 years ago, about 90% of its rental revenue was coming from Magna. Today, as Kevan just reported with Granite's Q2 results last week, Magna today is about 25% of rental revenue. Just shows you the tremendous job he and his team have done. There's no doubt the industrial real estate market has become the darling in the real estate sector over the past 5 or 7 years. And as I say, Granite's one of the leading players in this space. As I mentioned earlier, they not only offer the stability, but they also conservatively manage their business with among the lowest debt levels, loan to value about 30%, net debt to EBITDA about 7.5 times. Granite has an all-in cost of borrowing of about 2.5%, I think, if I've got it right. Now, that's in an environment where interest rates, the overnight rate's 5%. Residential mortgage rates are over 7%, 2.5% cost of borrowing. So excellent job, Kevan, and welcome. Thank you for joining us today.
It's always a pleasure to be here and do this.
Now, last week they announced Q2 results, and I would say it's probably, when I look back over the last 7 or 8 quarters, it was been one of the rare instances where the market reacted a little negatively.
Yeah.
Some would say that maybe the market didn't perceive this correctly, Kevan. What are your thoughts on the market's reaction to some of the FFO numbers or occupancy numbers you reported with Q2 last week?
Yeah, it's a great question. We did have, with our CFO, Teresa Neto, we had a good conversation about it, and you're absolutely right. It's not normally our practice, and I don't think it's common practice to guide analysts to a quarterly result. And frankly, we don't want investors and analysts focusing on such short-term results. But we understood because we were stabilizing a few development assets, and so those costs associated with those assets were moving from capitalization to expense. We knew that the second quarter would be somewhat softer than the first quarter. So we were projecting around 123 a unit, and analysts were expecting 125 to 127. So what we took from that is, to the degree that we can see that there is going to be a change from quarter to quarter, maybe we should talk about it a little more. So we did talk about that, and we learned. I think what was sort of confusing, though, or not confusing, but I think the market sort of overreacted to was, and I was asked the question on the call, 97.8% occupancy to 96.3%, this drop of occupancy surprises. Whereas it was fully within our expectations and on budget for us, because we knew 1.5 million square feet of space was coming to us through development and a turnover in Louisville. So everything that happened in the quarter was on budget for us, but maybe not as well communicated as it should have. And FX hurt us by a cent, which is not a lot, but just a reminder that FX helps us sometimes and hurts us sometimes. And that's something that analysts never take into account, is movement in FX from quarter to quarter.
So as we hone in on those results, I think about 80% of the vacancy is in those 4 properties in the U.S., some that have just been completed, one with a tenant turnover, that I think you did a pretty good job signaling that was underway. Now, we've seen tremendous momentum in the industrial real estate market. Is there any kind of guidance or any indication you can give us about the timing and the rental rates that you may be realizing on those properties, Kevan? And would that be different than maybe what you would have thought 6 or 12 months ago, just given what you're seeing today in the market?
Yeah, so it's a great discussion to have, and I'm happy to have it, because with Granite, we pivoted in 2021 quite sharply to development. And it was the right move at the time for a lot of reasons. And one of them is, we're built to develop. It's in our DNA, and we weren't doing enough of it. We're acquiring stabilized assets. So really, to maximize sort of the value add for investors, we pivoted quite strongly into development in 2022. 5.5 million feet was delivered or was to be delivered in 2022 alone, roughly 10% of our portfolio. So a massive investment with the understanding that that income would not really start to hit our financials until 2023. But 4 million of it was speculative, and 1.5 million was design build for large tenants. It was all to be delivered in 2022, but because of global supply chain issues, which everyone I think is well aware of, 2 million was delivered in 2022, and 2 million was delivered this year, recently. The 2 million that was delivered in 2022 is 100% occupied. And the 2 million that's delivered now, although it's early days, is 35% occupied. Is it a coincidence? I don't think so. I think we are seeing sort of a moderation in demand, which we've talked about, but off very, very highs in 2021 and 2022, like really unique years. But that being said, the market rents in those markets from 2022 to where we are today are up 20 to 30%. So I do think that it's going to take us longer to lease up the space than maybe someone would have expected last year. But we've always budgeted a 6-month to 12-month stabilization period for our developments, always. And that's very standard in our sector. And I think that that's what's actually going to happen here. But rents that are 20% to 30% higher than we would have performed and would have achieved if we had stabilized them in 2022.
So bottom line is, it sounds like you're kind of meeting the timing and the rental rate expectations that you would have thought earlier this year. Fair to say?
Fair to say. And I would say that our returns and the profit on those developments is intact from original performance in 2021, which would have been rather aggressive, understandably rather aggressive performance.
Yeah. And typical of Granite's strategy, you're looking for kind of single tenant as opposed to maybe some of your competitors, Kevan, which would look to potentially, maybe in a slower rental rate environment, look to maybe subdivide and bring in multi-tenants. What's the thought behind that?
Well, I'm not so sure it's a single tenant. We are rather agnostic around multi or single. The important thing is that we are pursuing modern logistics. And you talked about Magna and Magna 25%. And actually, it's getting a little annoying. We can't get it down because we're raising the rents on Magna. It's a good problem to have.
Yeah.
And listen, you talked about stability and growth. I'm really happy that you mentioned it because I get asked questions by investors all the time. What differentiates you? And I don't really feel a pressure to point to anything specific or anything earth-shattering that's differentiated, but it's about stability and growth. And you know what? In 2020, during the pandemic, we collected 100% of our rent. And I'm not aware of a real estate company anywhere that did that, anywhere. Magna was a big part of that. So there's that stability. But at the end of the day, we're pursuing modern logistics e-commerce. That's who we are in our DNA. And so most of our buildings are single tenant. Most of them are larger. And in our opinion, that provides more stability in downtimes. I don't think you really, as a company, have to worry too much or should worry about the good times. I think you have to always prepare for the bad times. The balance sheet, the capital structure, payout ratio, all these things are key, and also tenant credit and just the viability of the business. And the development piece is also about stability because it's always building new, it's always responding to what the market needs, it's always responding to sustainability practices. All these things I think are essential for a company that wants to be best in class. Right, and that's where we are today, hopefully.
Yeah, I understand those points, and I think that's really consistent with how you've positioned Granite over the years. Just circling back quickly on rental rates, we've seen some eye-popping numbers in the past 12 months, even early part of this year, from the industrial market generally. Some would argue that we're finally starting to see, and you alluded to this, some slowing in that rental rate growth. What are your thoughts on that as you kind of sit here today and maybe look forward the next 12, 24 months?
I agree. I think even if we looked last year, we came out of 2021 And really that was, 2021 was the story of Amazon. Okay, you look at 400 million plus of net absorption in the US, half of that was Amazon. We knew that was unsustainable, it was unhealthy for our sector, frankly. So heading into 2022, but it just continued. And in that case, it was more conventional retailers taking up space and less Amazon as they step back and sort of right-size their organization. So it was still very strong. So we were surprised how strong it was. So heading into 2023, we forecast a moderation in rent growth. But here we are today, and I listened to Prologis' call the other day, maybe their Q1 call. They were projecting 10 to 12% overall growth. That's kind of what we're seeing. Halfway through the year, we are literally, from the end of 2022 to today, across our markets, average market rent growth of somewhere between 8 and 12%. So very, very strong. We're waiting for that sort of moderation in rent growth. I believe it will happen. I still think it will exceed inflation across our markets just because of this overall need for resiliency in supply chain and now nearshoring, which is a real thing in our market.
You're seeing that from clients?
100%.
Really?
Well, our large new build, 844,000 feet in Nashville, is an electric vehicle maker. So that's I think, I don't know for sure, but I think that is a direct benefactor of the Inflation Reduction Act in the US, the IRA. And we're seeing that. And you're seeing manufacturers take up space like ours, which are just, they're modern boxes that can be used for multiple uses, including manufacturing.
Yeah, it's interesting to see that, because we're hearing that not only from you, but we've got exposure to some Blackstone strategies, and they're hearing the same thing, that nearshoring, just in case versus just in time, onshoring of inventory management that's happening across the board. Let's talk a little bit about liquidity. And again, one of the reasons why Granite is such a core holding in our funds, because you've managed your balance sheet properly, and you've got plenty of liquidity that, as you say, helps you through more challenging periods, more importantly, but also gives you the dry powder to take advantage of opportunities, whether that would be development and or acquisitions. And looks like maybe you've taken your foot off the gas there a little bit, like your competitors have. What are your thoughts there in terms of that growth strategy through acquisition and or development?
Yeah, I think we still talk about liquidity in our calls. And I think it's interesting to me, in talking to a number of investors, even at the beginning of this year, the feeling was, well, when are you going to resume acquisitions? And there's two things I would say about that. I still think we're in a position where liquidity is our highest priority for us. And I'm not being doomsday. But I don't feel any imminent danger with our sector at all. We're fortunate to be in the sector that we are. But I think that there will be opportunities. We just have not seen, I think, a level of distress in the market that's commensurate with a lot of this overweight, over sort of lending that's going on, particularly in private equity.
Do you think that distress is something we will see at some point here, giving you some opportunities? Yeah.
We do. And so we're in a fortunate position for a lot of reasons. Some we've created, some we haven't. But we are retaining roughly $7 million a month in cash after CapEx, after maintenance CapEx. So our AFFO payout ratio is in the low 70s, that's intentional. And that's working out well for us. And so, we're using that to fund our active development pipeline, which we're going to shut down after this year, and wait for opportunities. And so one of the things that I do think is, when I look at potential areas of distress, is a lot of these smaller developers, particularly in the US, but Europe as well, will be in way over their head in terms of the land costs, and the construction costs keep going up. So your economic rents are very high. We had a situation in Nashville where we have a really well-located development site with 3 buildings, which we're working through the leasing on. And down the road, I would say, close but not in a strong position as us, is a developer that's looking for a capital partner at rents that are 25%, 30% above our asking rents today, because that's what they need to make the pro forma work.
Are they going to get those rates?
They're not going to get those rates. I don't think that they're going to get those rates, and I don't think they're going to find the capital. So at some point, the lender or someone is going to get involved, and I think that will create some buying opportunities for us when the time is right and when we feel comfortable with our liquidity. And I will tell you, we're not comfortable borrowing to acquire at this point in time. We're very happy with our balance sheet. And so not only do we need to see interesting opportunities, but we need to see market conditions and cost of capital make sense to us to move forward.
So start talking about geography now. About 55% Granite's exposures in the US, 25% or so in Canada, 25% in Europe.
Yeah, that sounds right.
And this really touches on Magna, because you've got some extensions you announced Magna in Europe, which you had signaled that were going to happen, and they did happen, specifically in Graz. And as you look forward here, Kevan, especially given, say, the relative strength of, say, the GTA market, I've heard Blackstone and I've heard other players like Prologis just talk effusively about this GTA market, which is, Lake of the South, largest green belt in the developed world, basically covering the north, the east, and the west. Rents really moving very aggressively. Is there any thought about maybe increasing your presence here or in Europe, where you might see some opportunities through distress over time that might alter this current geographic mix?
Well, I think, number one, the GTA is our single largest market. I think it remains our most important market, and it's something we've always been interested in. I think we've tried to maintain a pricing discipline, and that continues today. And this is all about pricing. And to me, I mean, Blackstone's been very active, but they've at times been the only one that's been very active, and we worry about that. And to put it into context, though, every quarter, and it makes sense, I've been spending more time on leasing fundamentals and talking about it on the calls. And I want questions from analysts. I want to have this discussion. When you look at the second quarter, in the first quarter, as a matter of fact, in the first quarter of this year, the only market where we saw net absorption in any of our markets was here in the GTA. And in the second quarter, 2 million feet of net absorption in Toronto, healthy but below the 10-year average. In terms of our markets, including in the US, it was 10th in terms of net absorption, which is growth in occupied space. And in the US, the top 8 markets for net absorption in the second quarter were our markets. So we're looking at opportunities everywhere. Obviously, we would love to grow in the GTA. And I mean that, and we always are looking at opportunities, but we just don't see pricing making sense right now. In terms of Europe, what's interesting to us is we have seen pricing move up for assets that have longer term leases with contractual CPI in this case, but long-term leases that are locked in. That's something that we haven't seen for a while, and now that's starting to come back. So maybe there is this sort of opening for stability. Investors are looking for core product and stability, and sustainability matters. I think when we're looking at large investments now, investors are starting to pay attention to the sustainability features of the portfolios, and understanding that you're buying small bay, it's older product, you feel you can push rents higher in a shorter amount of time, but you also have risks. And some of that is just the sustainability and obsolescence, which is a real risk now, and I think people are paying more attention to it. So I think it's an encouraging sign for us in Europe, and we are interested in growing there because we're finally starting to see that sort of embedded rent growth that we've been expecting for many years, frankly.
So beyond kind of 40-foot clearance, are there a lot of new features in a brand new industrial facility that really distinguishes it, which, as you say, provides that sustainability and your ability to continue to drive rents going forward?
Yeah, so you have to have very energy efficient features. So you have a white roof versus a black roof, which is more reflective. You have additional insulation. You have LED lighting, which is very light emitting diodes, which is a low energy technology. You have green roofs that we have in Europe, and we have a number of solar arrays on our roofs in Europe as well. Drought-resistant planting, all these things, they all factor into energy efficiency and sustainability. And I think for us, when you look at everything that we've built, we've made a commitment that it will meet the characteristics of our green bond framework, which we published, I think, in 2021. Frankly, we've raised $1 billion in green bonds since then. I don't know anyone in Canada that's done that. Maybe
And
wrong, but
are these efforts to make these buildings more sustainable really significantly driving up the cost, or is it a point of costs are higher, but you getting a real return on that investment?
we have not. I wouldn't say we've gotten a full real return yet. The expectation is that tenants will be looking for it, or will be imposed on tenants at some point. So we're sort of preparing for that inevitability in the future. But I will say, if you can demonstrate clear energy efficiency advantages, you might get a little bit more from the tenant, but you're still probably paying 5% more to have a green certified building, and you're not recovering that fully from the tenant. And then that's okay. At the end of the day, I think it's also something that's important to us corporately.
Yeah, doing the right thing.
In the end, we believe it will help us down the road. You have to have conviction that this will help you down the road at some point.
As I kind of look forward the next 3 to 4 years, do you think Magna's still at 25% of revenue? You mentioned the point where you're seeing some rental rate increases, which are causing Magna to stay stubbornly high at these levels. But is that a good thing, Kevan? Do you see this kind of working that way, or how do you see it evolving?
I think naturally it just has to fall. And I understand the question about, outright sales in Europe. And as I said, we're willing to be patient. We have a 10% renewal increase coming up at GRT, which is another 2.8 million euros a year for us. So that's attractive, and it's great stability. But at the end of the day, we're not pursuing manufacturing. We're pursuing e-commerce. We're pursuing modern logistics.
Yeah.
So it will naturally fall. The timing of it, I'm not sure. But again, I mentioned the encouraging signs in Europe. As there is more attention paid to stability and tenant credit, I think that there will be a time where we will start to actively downweight those assets in our portfolio.
It makes sense. Let's just finish off with a few questions on not fundamental, but more kind of macro. One thing we've come to rely on is that annual growth in dividend. Kevan, do you think that's going to be something that we can continue to expect going forward?
Well, that's a board decision, but I would say I think you've seen how important to us to put ourselves in the right position every year to do that. And at a Q2 payout ratio of 73% AFFO, I think we've done that again. So I remember when I joined 5 years ago and was looking at the distribution and whether to increase it, and I thought, you always try and make the right capital allocation for long-term value for investors. But at the end of the day, I didn't want to be that CEO that came in and stopped that track record. And I don't want to be that CEO that stops that track record. So it's really important to me and to us as an organization to put ourselves in a position to be able to do that. And I think we've done it again this year.
That's excellent. It's good to hear. With respect to stock price, something we can't control. The market's going to do what the market's going to do. You're driving the fundamentals in the business. I think there's been a number of reasons why, some more important than others, why REIT prices generally, not just Granite, have been held back and moving rates. What do you think some of the catalysts might be for the market to realize that there is real value here, trading at a substantial discount to what we think it's worth? What do you think some of those?
Yeah, and it's hard to see that it's tied to NAV because it's become fully detached from NAV. And I look at you mentioned I look at our price down over 30% from its highs in 2021, and yet our cash flow is up 20%. That's quite a swing. But understanding that everything that was low yield got hurt more than others because of the move in interest rates. But we really are confident and optimistic for 2024 because we feel that once the central banks just signal that they're going to stop and take a pause, and there is that possibility of rate cuts. I think a lot of investors, REIT investors, and even private investors are just waiting for a signal that central banks are going to stop. And I think that will be a real catalyst for us. I think the fundamentals are there. We've done what we have to do.
That's clear.
But I mentioned when people do talk about what differentiates us, I do point out selfishly that we spent $750 million on development ostensibly in 2022 with no income. But we had the cash, we had the balance sheet to do it. It made sense. But now that's starting to come online. Same property NOI is accelerated. will be around 7% this year, 6.5 to 7%. We expect similar, maybe even better next year. So the cash flow is going to continue to grow attractively. So we've done our job, and I think once the central bank signal some sort of pause, I think will be a real catalyst for the entire REIT sector and not just.
Yeah, and in fairness, late last year, early this year, most people thought, at least Bank of Canada was telling us, they'd probably be on hold, and we saw a real move in REIT prices. And then once they indicated that, well, they may have to start rising again, and we saw this pullback. And then that coincided with some of the regional banking issues in the U.S., which again, Granite doesn't have any of those types of issues. Your lenders are solid. You've got relationships. You've done your green bond issues. So we really don't see any of those challenges on the horizon either.
Yes.
So overall, when you look back at your 5 years so far at Granite, hopefully there's a lot more to come. What are some of the things that you may be most proud of, the things you've been able to achieve at the firm?
Well, I think we've really made some key enhancements to the team, the leadership team, the enhancements we've made to the teams in Europe and the U.S. When I joined, we had a platform in Europe, but I think we've made very significant enhancements to the team in Europe. In the U.S., we did not have a presence. So now we have a very strong platform led by John in the U.S. So I think the organizational improvements, a lot of governance improvements as well that gets overlooked. I think since I've joined, and a lot of that's by the board as well, but with my full support and the support of the management team. But I was looking at the end of 2022 in Q4, just reflecting on our track record. We generated, over the past 5 years, we've generated FFO per unit CAGR of 6.5%. I think AFFO is 5 to 6%, something like that. And at the same time, we dispose of roughly $1 billion of Magna assets. So when you think about that,
Replacing those assets with growth.
correct. But to high grade the portfolio by selling $1 billion of higher yielding assets and redeploying that in more core, lower yielding assets, and doing that and being able to grow FFO cash flow per unit for investors is, I think, something the entire team is very proud of.
Well, it's been excellent. We really appreciate the update, Kevan. Suffice to say, you've done an excellent job. Notwithstanding some of the challenges in the market, this is the reason why Granite is such a core holding for us, why we believe in the trajectory of the business and eventually the stock price really catching up to the fundamentals that we think are not only here today, but we think are well positioned to be there going forward. So thanks again, Kevan. Really appreciate it.
Thank you.